Day here. Charlie, what do you make of the action, especially into the close here? Got a nice little lift on all the major averages.
Not just a great day, a great week. This is actually one of the best days for value investing versus the S&P in 10 years. I think our Ariel fund outperformed the S&P by over 350 basis points in just 3 days, and that just doesn't happen very often. So this was a crowded trade. People betting that interest rates were going to go lower, that tech was going to go higher, that we might have a recession. That was a very, very crowded trade. And when everybody tries to get out of this crowded trade at the same time, you get this kind of pressure. So we are delighted that valuation finally seems to be mattering.
That said, Mike, it's not as clear a rotation as the first 2 days of this week. For example, utilities up a full % today, healthcare doing well, banks not the leader, for example.
Right. You've got a lot of the very urgent repositioning out of the way. And again, I think you have both fundamental drivers, you have relative value drivers, stocks versus bonds, and then you have mechanical drivers, which is people feeling trapped in positions that got stretched and then they reversed. And so I think that mechanical part of it probably worked its way through. And I think it's really been, in the last couple of weeks, a collective exhale. I mean, to Charlie's point, bond yields got too low and remain too low relative to stocks if bonds are not telling you recession's on the way. That's just kind of the basic equation I think people are trying to come to terms with. Now, S&P is 1% from its record high back in July. At that record high, 10-year Treasury was at 2%. Corporate credit is now also in good shape. So this trade can continue to work for a while. The question is when it requires a next act, something else beyond a Fed rate cut we know we're going to get next week to go higher still.
And Josh, I know you think that this is not the end, but we're going to go higher from here based on what you've seen, at least history, when we're looking at some of these markers for the Russell.
Yeah. Well, how could you hate a tape? How could you hate a tape where the MTUM, the momentum ETF, has this drastic 2-day move down and everything else explodes higher? And now you have regional banks rallying with semiconductors, which are 1% away from an all-time high. What is to not like? And I'm going to tell you, I have this conversation with smart people every week, clients, potential clients. These are multimillionaires, people who have been successful in their life, but they don't get it. The market is not here to reward you for linear thinking. The market is here to torture you and drive you crazy. That's what it does. It does it to all of us. And so just when you think you've got it all figured out, I'll own the highest momentum stocks in the utilities, my barbell. Look at XLI right now, industrials. This is a group of stocks that could not get arrested all summer. Nobody would even talk about them. They look like they're about to have a massive breakout. Combine that with small caps, value stocks, semis. This is a market that is torturing you. Just when you thought you figured it out, no one's ever going to figure it out permanently. And I think this week is a great reminder of that.
Which is why, though, if you're up another 3 or 4%, and you think you got it figured out because everything's okay, right, and guess what? Everyone's too bullish, then it's going to fall apart for some reason you don't see coming. So I think it works.
You've been doing this
ways.
Long enough that you know this.
Well, yeah, I'm not saying it's going to be 3 or 4%, but you know.
Yes. But Mike, does record all-time highs as a headline spook the market again? That we've bounced too quickly, or we've tested it enough times that we can now go through?
I don't think it in itself, no, it does not spook the market. I mean, usually all-time highs lead to further all-time highs. It usually does not turn on a dime that way. But I think it ultimately at some point, at some level, becomes a reminder that it might take a little bit more. You know, you're going to get back into earnings season soon. So I think the wheel turns constantly, and the market needs to be fed at some point something more than, hey, everyone got too bearish in August.
The rates thing is big, though. If it holds. I don't think you need to see rates go higher.
No, you don't.
But equilibrium here, I think, is a powerful signal.
That's why you're in good shape.
Right? Like emotionally, I think that's important.
Charlie, financials have been a big outperformer this last week or so as the rotation has kicked off. What's your top pick in that sector?
Well, the financials have been beta related. Banks don't tend to do real well in a recession. Obviously, they don't make a lot of money at a 140 10-year. Everything was bad for banks 2 weeks ago, and now we have a much better situation. But it is all tied to the economy. The reason we got where we got with a 140 10-year was because everybody was sure we were going to have a recession. And the fact of the matter is, if we can get some kind of trade deal, we are not going to have a recession. We've got an extremely strong consumer. If we get a trade deal, this market is going to go up a lot.
Charlie, are you staying away from some of these trades that you say were crowded for a while? So like a tech trade, is that something that you're not interested in at this point?
Absolutely. This is just the start. We have it when the dot-com bubble burst. We had value stock indexes outperform the S&P by 33, 35%. We have just had the beginnings of this with this reversal today. We had inflated tech valuations, which are such a big weight in the S&P. People think the market is expensive because they look at the S&P. If you look at value indexes, they were trading at 13 times earnings. We have Goldman Sachs trading at less than book. We have Borg Warner trading at 9 times earnings. There are a lot of industrials and high-quality financials trading at very attractive prices here.
Mike, we've also, in the last week or so, seen gold come down, clearly yields go up, the VIX also fall.
Yeah.
All of these very bullish.
It's been just kind of a tension release dynamic across the board. So whatever basically you felt forced into in August, you've now been prompted to get out of right now. So that's the tactical backdrop. But I do think, we're on a more normal footing and just trying to figure out, not so much are we going into a recession tomorrow, is the yield curve screaming at us every day that we have to be more worried than we were yesterday. We're out of that mode, but I still think that nothing has liberated us from that bigger picture debate of how much longer is left in this expansion. Are profits really going to reaccelerate the way the forecasts say, and all the routine questions that we always have?
It's true. The fundamentals remain largely the same.
Josh and Charlie, we'll leave it there. Thank you both very much
for
joining us. Great to see you.